Hey folks, Dan Frio here I got some breaking news for you on May 23rd, 2025. We just had Redfin come out saying they're expecting home prices to drop. Is this the crack in the housing market? We also are going to talk about bond vigilantes, what that means for mortgage rates. So my name is Dan Frio. I do this report 2 times a day to inform you guys what the heck's going on with these things over here. The reason why, I'm actually a federally licensed mortgage loan officer, and if you're looking to buy or refinance, I'll give you all my information at the end of this video. You're here for these things. So let's get to it. Right now, what we had this morning is we had President Trump come out and threaten the European Union on tariffs, and that's a daily occurrence, it seems like, anymore, and also threaten the Apple that he wants Apple products made here in the United States. How's that going to fare? Well, we're going to see over time, but the market's recovering a little bit. This was down over 300 points recently. It was down all the way across the board, and that's what we're seeing there. Now, on the interest rate front, pretty good day for bonds today. We have the MBSs up 16 ticks. For anybody new here, basically all you have to understand up here is this. This is the price of a mortgage bond, okay? In most bonds, they represent, when they're showing you kind of charts and things, what they show you is this. They show you interest rates. So look at this one. It says 4.5. Well, that's the yield on the 10-year Treasury. But if you go over to the mortgage bond, they make it a little confusing. They give us the price, 98.39. So we kind of have to decipher this. So to make it easy for you, all you have to understand is that if the price goes up, which it's doing today, rates are coming down. Let's look at a 2-day chart. I think it's been pretty good. Well, it started here and at least it's a little bit up. Let's look at what happened for the week. We're basically back to where we started the week back there. So that is great news for the market. So we locked in a lot of people through here. Down through here is when rates were going up. Rates started coming in a little bit better yesterday, and we're going to ride this wave, and hopefully it continues up to at least fill in this gap up through here. So if you watch me daily, I'm kind of a chartist, and I kind of like looking at these things. So I'm assuming there's going to continue to be a rally in this market unless the president does something, well, who knows what's going to happen tomorrow. So let's get over to here. Here's new home sales just came out, and we have Redfin talking today, and he's predicting the housing market to go down. Is he predicting a crash? What's he predicting? Well, let's get over to him. But when you come back, I want to also show you're truly interested in mortgage rates. The bond vigilantes are back, and I want you to understand how this works and also how it plays a role in mortgage rates. But first, let's go over to Redfin, see what they're predicting on the housing market, and then we come back. Let's check it and see what's going on in the bond market.
New home sales this morning out, coming in stronger than expected in April. In fact, the highest level we've seen since February 2022. But with mortgage rates on the rise and all the economic uncertainty, can the momentum continue? Let's bring in Redfin CEO Glenn Kelman. And Glenn, our Diana Olick said it was an anomaly, and we know these numbers can be volatile. What are you saying? Does it jibe with the big surge in new home sales? Also came off of a weak March, we should mention.
It's somewhat anomalous, but it is a fact that builders are competing effectively against people selling existing homes. Whenever the market is changing, and it is changing right now, where home prices are softening, it's taking more than 40 days to sell a property. Builders are usually the first ones to aggressively lower prices. And so that reaction has allowed the builders to tick ahead. I don't know if it can be sustained long-term, but definitely we have seen builders compete more effectively than the traditional sellers of homes.
What is the overall market telling you just in terms of demand? I get that it's competitive and the new builders are competing, but what does demand overall look like with mortgage rates back at 7%?
There has been a real shift. So home buyers over the past few years shook off rate increases. Home prices kept rising. We anticipate that prices will fall at least 1% in the second half of 2025. And when you compare that to 4% wage growth, it means that finally home buyers may be in a position to catch a break. But it has been very hard to put deals together over the past few months. And that is because sellers still have higher expectations from previous years, and the buyers are now standing back. Some of that is macroeconomic anxiety. 1 in 4 Americans right now say they are canceling or deferring plans to buy a car or a house because they're so worried about the economy. But we are seeing finally evidence of a real correction where prices are going to come down.
Okay, so his Let's get over to his correction. I don't know if he said it yet, but he's going to tell us how much he thinks this crash is going to come to. I think he's going to come and tell us in this segment.
Do you think that if the labor market weakens substantially, people feel like they have to move, mobility increases because their search for a job has to widen? Does that actually end up being good for sellers?
I don't think that a weakening labor market is good for anyone.
Yeah.
So people will always move for jobs. Right now, the only people who are really moving at 4 million existing home sales a year are the folks who have to. So it's death and divorce and other major life events. Opportunistic movers are headed for the hills. So right now, we just need a really stable economy. We need things to settle down. When the stock market goes crazy, people in coastal markets can't afford a down payment. When folks start worrying about their jobs or about prices, they put off big ticket purchases. So there really isn't a universe where I would imagine that uncertainty in the labor market would help the housing market.
So he did make a comment in the section. I think he said that he's seeing a correction of about 1%, real estate going down 1% over the year. And I've been saying this for I'll go back 3 years now. I've been saying the market's just going to be flat as a pancake. Unfortunately, in my area, we still have prices going up and away. We just had my neighbor's house just go up for sale. We're going to see how fast that goes. I'll keep you in tune on that. I won't tell you the price, but I'll let you know how long it takes to sell that property. And it's right next door. So let's get over now why you're really here as we talk about mortgage rates on a daily basis, and we want to talk about the bond market. So this is an interesting interview right through here, and I want to tie in the real estate. Now, we know real estate's cooling down, and I completely agree with everybody. The crash, people are probably all excited right now, but a 1% correction, But I also see, many markets should just stabilize, and they can come down, 3, 4, 5% because of the gains that we've seen over the last couple of years that on a stagnant market was still kind of astonishing in a lot of areas. But let's get over now. The bond vigilantes are coming back, and this is a great explanation. I know the video is going a little bit long, folks, but this is a fantastic interview to understand the bond market and how it's kind of getting manipulated right now by traders and so forth. And it gives us an idea of where mortgage rates are going to go short-term, mid-term, and long-term. So let's get over to this interview real quick so you can understand the bond market a little bit deeper. And then when we come back, I'll give you my expectations on mortgage rates.
This morning, they're a little lower than they had been earlier in the week, but we are talking about elevated levels that's been taking course all week since the Moody's downgrade last week. The 30-year this morning is at 5.03%. The 10-year is at 4.52. For more on this week's action in the bond market, we want to bring in Subhadra Rajappa. She is the head of U.S. rate strategy at Societe Generale. And Subhadra, let's run through what we're talking about here. Ray Dalio has a warning that's out there. He says, I think we should be afraid of the bond market. I would say that if we're really looking over the next 3 years to give or take a year or two, that we're in a type of critical situation. Do you agree?
Yeah, we're definitely at levels that we should be concerned about, 5% in 30 years. And if for some reason, if we start seeing a continued sell-off in the 10-year towards that 5% level as well, that I think is a bit of a concern. But
remember the video this morning? If you didn't see it, please check it out. I'll try to put it right up through here. And it was Rick Santelli on CNBC. He starts talking about the 30-year that everybody's starting to talk about today. It's a really interesting video. You need to check that out to understand. A lot of people are starting to talk about the 30-year Treasury bill that really hasn't even been in existence over the last 4 years. So kind of, is it a diversion? I don't know, but we focus normally on the 10-year Treasury. So just so you understand, a lot of the dynamics and a lot of the things we review are on the 10-year Treasury, not the 30-year.
this is not just a U.S. phenomenon. You're seeing global bond yields rise. You're seeing this unraveling of correlations between all the different assets. I mean, typically, when equities sell off, investors flock to the safety of bonds and the dollar. That's not happening. And you're also seeing at the same time that investors are really demanding a term premium for bonds, not just in the U.S., again, also globally with JGB yields going higher. So you're seeing this kind of very, difficult picture, if you will, for bonds globally.
I mean, 5%, I know that's at the very high end of things over the last 18 years. Mm-hmm. But if you look historically, it's really not subnormal, out of the norm. And we've seen rates that are much higher than this going back historically. Is this really the bond market sitting up and saying, we're not going to continue to allow these global fiscal deficits to continue?
Yeah, for sure. I think this is bond vigilantism at its early stages. I mean, we saw that back in August of 2023 when the Treasury increased its coupon issuance sizes. You saw bond investors push back and 10-year yields started going towards 5%. So this is definitely the bond market kind of sounding the alarm, if you will, on the fiscal situation in the U.S. as well as globally. You're also seeing that the Fed is doing quantitative tightening. So the largest buyer of treasuries is stepping away, and the demand dynamics are generally quite weak as well.
Bowder, you are stressing that it's a global phenomenon. I'll tell you where I'm going with this. For the second day in a row, and we understand the journal, but they're running interference for this reconciliation bill. They're saying, do not blame the backup in yields to what is a pro-growth tax cut strategy. But then others are likening it to what happened in the UK with Liz Truss, which resulted in her the country backtracking on all the tax cuts. And now they're stuck in kind of a malaise. Do you tie this back up directly to the reconciliation bill? Or why did the light switch go on 37 trillion? Why did it just happen now that, wow, we might have a problem here?
A great question that he has, and this is again with Rick Santelli on that video I showed you earlier. Why now? All of a sudden, everybody's concerned about the deficit when we've been ringing this bell for years. So that's the confusing part of a lot of this right now, and that's what he just came out and asks. Let's get her opinion on this. I know the video is going a little bit longer than I usually try to do, folks, but you need to know these things.
So it's really a confluence of factors, and I think we've been building up to it for a while now. I would say that starting with the Liberation Day on April 3rd, you saw the initial reaction in the bond market was towards lower yields as equities sold off. And then we quickly reversed course when uncertainty started to rise. And then we got the downgrade from Moody's last week. So,
Did
this
that
sort of
really mean
fiscal,
anything, though?
not really. I mean, I think that this is one of many data points that we're looking at. If anything, I'd say that the bill that's been passed in the House is better than what I had anticipated. The question now becomes what happens.
Better how? Because of the cutting the 1.5 trillion or whatever.
I mean, the pushback has come from the deficit hawks, right?
I mean, this adds to the deficit.
It does add to the deficit, but they've tried
they keep selling the growth.
But can you have a pro-growth bill if you're doing this in conjunction with changing the tariff structure in the United States, around the globe, actually? I mean, I think that would be the bigger question. Is it going to be pro-growth if you do it hand in fist with the tariff?
I think Becky has a very good point, because this comes in the broader context of what's happening with tariffs and what the impact of tariffs are going to be on inflation. Is this sort of pro-growth tax policy going to be an offset for the higher prices that consumers have to pay because of tariffs? And this package is not as stimulative as it was back in 2017 when the first sort of tax cut was passed. So the market's trying to suss out all of these different outcomes, and you're seeing this rise in yields.
And taxes aren't going up. So to service the debt, we need the growth to work. We need the growth components to be positive. So that's another thing I thought it was sort of an inverse way of looking at it, that the worry is that there won't be enough tax revenues because we won't have the growth. So interest rates are going to go up because we're not going to be able to service. The 20-year auction might have been the first sign of that. No?
Yeah.
Yeah?
For sure. I mean, I think that long end yields are rising, and really the buyer's strike is in the very long end. I mean, the 10-year is still relatively contained.
Yeah.
I think that over the next 3 months, 10-year yields probably trade somewhere between 4.25% to 4.75%. I think you start getting towards
but
5%.
You're not going to get the relief on things like mortgages, car loans, all of the things that drive the consumer.
Yeah, and you're seeing that play out in the data with existing home sales, starting to weaken. You really need to see that 10-year yield start to come down towards that 4% and below to see those borrowing costs start to ease up a bit, and you're just not there.
What if it gets...
So that's what we try to talk about on a daily basis. And this is basically ties in everything we talk about. So we talk about real estate, which hopefully we covered right through here. Redfin saying the markets are going to be completely stagnant or maybe even down this year, which he said down. And then now maybe understand a little bit about the adversity we're having right now in the bond markets. And this is all tied to mortgage rates. So that was my special report for today. The markets did close early today. So let's go back and refresh this to see where mortgage rates went for today. So we're down to 7.02 on the 30-year fixed. A nice little reprieve. We were down 5 basis points today. I think it was 1 or 2 from yesterday. So a nice little move on the downward. We're going to see how the weekend goes with all these tariffs, the EU fight, the Apple fights, and everything else. So hopefully you learned a little bit about economics and real estate today. My name is Dan Frio. My slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. Well, here's how this works, folks. I'm actually a mortgage or federally licensed mortgage loan officer. I work at a federal bank. That's what I truly do. And the bank that I work with is set up with 30 other lenders to help assure you guys when you're applying with our branch here, that we're shopping your loan to over 30 different lenders to make sure you're getting options so you don't have to go out there and shop on your own. How does it work? Well, reach out to us. We'd love to be able to help you with that. You can schedule a call with us. You can give us a phone call, or you can even put in your application right over my head, and what will happen with that is it'll launch right over to me. I'll get an alert that you put in your application. I'll be calling you to go over any information. So please don't worry about us pulling your credit. So you could put in all your information in there, but the next step is just putting in or going through one of these things, and we'd love to help you navigate if you're looking to buy or refinance in 2025. Thanks for watching, folks. Have a great weekend. See you next week. Take care.